Hello, this is Eric Parnell, Chief Market Strategist from Great Value Advisor Group. And today I'm here to talk to you about bonds. Now, before you click away thinking, bonds, boring, I'm here to say bonds, interesting, because they provide a great diversification benefit to stocks and an overall asset allocation portfolio. The key is it has to be implemented right. Now, when we're talking about bonds, we're talking about instruments like US Treasuries, corporate bonds, and mortgage-backed securities, among others. And if we take a look back over the last 25 years, we can see some of those periods where bonds provided a great benefit. We'll start with the financial crisis from 2007 to 2009. This was a period when stocks fell by more than half. But if we take a look at treasuries, they rallied by double digits, providing a good offset to the downside that we saw in stocks. We fast forward to the COVID crisis of 2020, where stocks fell by 35% over a 2-month period. During that same time period, we saw US Treasuries rally by double digits once again, smoothing out that performance and helping cushion against the downside that was coming from stocks. Now, we've seen more recently in 2022, both stocks and bonds performing poorly, and that was due to the spike in inflation. So one of the things that we need to evaluate in the current market environment is the opportunity associated with bonds good, given all of the lingering concerns about inflation. First thing that we need to look at in that regard is where do we stand with bond yields today? And the good news is there's a great opportunity with bonds, even despite the lingering inflationary concerns. With inflation, it peaked in 2022. Headline inflation rate peaking over 9%, core inflation that excludes food and energy peaking over 6%. Ever since that time, inflation has been steadily falling. Yet what we saw in 2023 is that Treasury yields and bond yields continue to rise, reaching as high as 5% on the 10-year Treasury yield by October of 2023. This created a tremendous window of opportunity for those investors that wanted to buy bonds. But what we saw in November and December of last year is that we saw a great rally in the bond market. As Treasury yields fall, that means the bond prices are rising. It looked like the window of opportunity to own bonds had slammed shut at the end of last year. But what we've seen in 2024 is the opportunity for a second chance. As we've gone through this year so far, the economy has been stronger than expected, and the expectations for Fed rate cuts, which helps the bond market to rally, have been pushed back to the end of 2024, if not into 2025. That's caused bond yields, including US Treasury yields, to rise back towards 5%. It's giving a second chance for investors to own bonds here as we move towards the middle of 2024. But there's a second question. What about all this talk about hotter than expected inflation? Inflation numbers continue to be hotter than anticipated as we go through 2024. Doesn't this present a problem for the bond market? Not necessarily. Even though inflation has been hotter than expected, the trend in inflation continues to be lower inflation rates. That's still good for bonds. And the other thing to highlight is that the yield that investors are getting paid now to own bonds over the inflation rate is as high as it's been since before the financial crisis in the mid-2000s. In other words, we're seeing a buying opportunity in bonds that we haven't seen in 20 years. Now, the key is that inflation needs to continue to trend lower or at least flatten out. And that's going to be important to watch as we go through the second half of the year. But there's another element here, and it's relative. We have a choice between owning bonds or owning stocks. And one of the things that we see in the current market environment is that the yield that investors can receive on a 10-year Treasury is at nearly 4.5%. This is in comparison to the earnings yield that investors can receive on stocks, which is the price to earnings ratio flipped upside down, which is only at 3.7%. So basically, investors today are getting paid an extra 0.8 percentage points for taking on the less risk of owning bonds relative to owning stocks. So as we look ahead through the remainder of 2024, we've seen a tremendous rally in stocks going all the way back to October 2022. But bonds really haven't participated up to this point. But the good news that we have for bond investors going through the remainder of this year and into 2025 is that the fundamental backdrop and the value opportunity is as good as we've seen in bonds in years. Thanks for joining me for this latest Market Insight, and I look forward to seeing you again soon.